Hello, everyone. Welcome to another NMP webinar. Thank you so much for joining us today on this beautiful but cold Wednesday, fresh out of the New England Mortgage Expo. We are bringing you some of the top non-QM experts in the country right off of the New England Mortgage Expo, where they had a lot of conversations about non-QM. They were part of the non-QM summit. My good buddy Ben here ran the non-QM summit, who does an unbelievable job. But listen, but first, before we get started here, everyone take your phones. I'm going to be a good steward of your time. We're going to give you an action-packed 40, not 40 minutes, 60 minutes of content. Maybe 40 minutes. Maybe we'll get you out in 40 minutes. Who knows? But turn your phone off. I'm putting mine to silent right now. Put it over here. Hopefully, you'll do the same right now. Shut down Encompass, Calyx, Outlook, whatever you got open. Just give us, another like 58 minutes. I promise we're going to be a good steward of your time. Introducing our guests here. We have one other gentleman that's going to be joining us, but okay, so we got Ryan who's going to share his insights on the street. Ben who's going to share not only his insights, from the booth, but he's also going to share his insights, from running the non-QM summit, from spending time with, some of like say the top non-QM experts, not only in Angel Oak, but at every company out there. Non-QM summit is we're fortunate and blessed to have some great companies participating in it. We're fortunate enough to have Angel Oak as our lead sponsor. But today, listen, we had a lot of conversations around non-QM. I mean, we obviously know like the people that are like killing it in the mortgage business right now, are many cases doing it with non-QM, whether it's like, an important part of it, and they're leading with non-QM and focusing on non-QM. And there's some of those guys out there, or they're just making it as a part of their offering and making sure that it's not just a fallout option if all else fails, because that that rhetoric left in 2019. So none of that. But okay, gentlemen, talk to us. How was the show? If you could share us, how was the show, Ryan? If you don't mind, kicking us, tell us your feeling. How'd the show go for you?
Yeah, for me personally, it was a great opportunity to meet some current clients and some prospective clients as well. A good opportunity to teach some people about what non-QM is, why picking Angel Oak and picking a right partner is so important. And it was a good opportunity for getting the word out that DSCR is now available in Massachusetts through Angel Oak. So that was some big news as well shared at the expo. But we had great attendance. I think about 1,400 people came out throughout the week. So it was a really great event.
Fantastic, great. Um, well, how'd you feel the energy was? Like what was like the vibe in the room? Were they excited? Were they like hoping and praying that refi boom will happen? Like what did you feel like the energy was in the room?
Yeah, I think the energy was cautiously optimistic. There was a little bit of a buzz, maybe not so much as there was in previous years before COVID, but this was certainly an opportunity for people to kind of connect, to get really, really out of that COVID rut, shake off some of that rust, meet people, have a good time, and kind of connect to see where the mortgage world is headed. I think people weren't so much afraid of a boom or a bust. They were kind of optimistic about just a reset in general and how we tackle the new world of mortgages.
Fantastic. Oh, that's great, man. Good to hear that. Ben, talk to us. How was the show for you?
It was awesome as usual, Andrew. I mean, you know me. I've been coming to Mohegan for ooh since before I was with Angel Oak, so that's gonna date me a little bit, but it's one of my favorite conferences of the year. I manage the Northeast and Midwest, and this is arguably my favorite conference to go to, just because it's a large conference. You get a lot of people from different parts of the area. You get people all the way. I live north of Philadelphia, so you get people from Pennsylvania, New Jersey. You get a lot of the New England group coming in also, which is a lot of fun, right? You get that many people with that many different markets, and you get them all in the same room, and expressing opinions, and what are they facing? It's a lot of great collaboration. But obviously being able to host the summit every year is for thank you, obviously Andrew, to you and Ambiz and Originator Connect for allowing me to do that. It's a lot. I get a lot out of it. I have a lot of fun doing it. As anyone who's able to attend knows, I normally try to have a lot of fun doing it. But another great show, great location, great place. It was just everything about it, even the layout of the exhibit hall. It really isn't, there's not one negative, to it other than, you're in Connecticut in January, but no offense, Vince, if you're listening to this. It could have been, it could have been Orlando, but it'll be good.
Yeah, yeah, I'm with you on that, definitely. Yeah, listen, but you know, us Northeasters, we need a place to go, and I think for the first conference of the year, we start off the year strong with that, but yeah, I'm with you. Florida would have been nice too. Just how'd you feel the energy was in the room? Like, when from conversations you've had. So now you all not only just talk to brokers, but you also spend a lot of time with the other executives from other non-QM lenders.
Yeah, that's kind of, I mean, that's one of the best parts about the summit itself is that you do get industry leaders up there talking about, from their perspective, not only just their personal perspective, but their company's perspective. So, when we talk about the energy in non-QM, you're not just hearing it from one company, right? It'd be one thing if just, hey, Angel Oak's got this approach or this opinion. It's everyone has the opinion of, I mean, non-QM is going to be such a bigger piece of the market this year and going forward. So, um, when you get your competition on stage with you and you're able to just, really just talk it out a little bit, you really get to know each other a lot better than we already know each other pretty well because non-QM has always been kind of a small little piece of the puzzle. Now we've obviously grown incredibly well, but most of us know each other. So, being able to sit next to like Vista's chief revenue officer and John Wise from NewFi, who's head of sales over there, and Lucas from SunWest and Angel AI. When you start to you sit with these guys and really it's the collaboration approach and understanding what they do and they can understand what we do. It is reaffirming to know that we all have the same outlook. It's
Community.
one thing for our capital markets folks and everyone to sort of have their opinion on it, but it's another thing to have everyone else on the same opinion. So it's definitely a confirming piece.
So I'm just curious, but Ben, why do you think actually that the non-QM executives are so much more collaborative than if you just look at the agency and govy wholesale lenders, not like they're all cutting each other's throat. Well, okay, two of them are, but for the most part, our non-QM, you guys are like, hey, we're in this together, let's hold hands and we will grow this thing together. Why do you think that is?
I think it's because we all have our appetites, right? So the agency world is just very vanilla, right? And you're competing for a couple bips here and eight there, or just the cost. Non-QM loans are so different because there's a story behind our loans, right? All of our loans are manually underwritten. It's the exceptions that are on our side of the street are so heavy. So, there are certain companies with certain appetites that, like this or don't like this as much, or you have a lot of that. But I think the biggest thing is, for so long we've been trying to beat down the door of traditional loan officers saying, hey, you need to incorporate these programs into your offerings. You need to offer these because of the next generation of home buyers, right? The blueprint of borrowers these days are changing. Self-employment is only growing. And again, like my breakout session Friday morning, talk about the number of business applications that have been filed since 2020. Haven't been this, they haven't been that high since right after World War II. And so in the middle of a pandemic, there are more business
Wow.
applications filed than 2019. That it tells you where kind of your borrower profile is moving. So, gig economy, like entrepreneurialism is big, and especially in the millennial and Gen Z generations. So when you're looking at diversify, try to offset maybe some of those tight agency, markets. Our programs are really made to fill that void, and not just non-QM, just niche lending in general. I mean, it's going to be a huge part of really the future.
I think part of the difference too is non-QM, there's a lot more hand holding as opposed to agency. Agency, like you said, it's vanilla. You
Yeah.
pop it in, you give it to your processor, and that's it. There's loan structuring involved with non-QM. That's why your AE is important and the company you work with is important. If you just throw it in, it's literally throwing it against the wall and hoping it works. That doesn't happen with Angel Oak. You have to have a pre-approval with us. So submission to close ratio increases exponentially because we won't let you submit a loan without a pre-qual. So we know that it's going to fit the system. And we also have something better than that. If it doesn't fit the system, we have a pre-submission exception underwriter who, if she says it's go, regardless of what the underwriter guidelines say, which is nice.
I'm also going to, listen, a shameless plug for Angel Oak. I just was having a conversation with Tom Hutchins. Tom is the president of Angel Oak Mortgage Solutions. He's really the first person that I learned about non-QM, and he talked about actually how the two like most popular products in non-QM, bank statements and DSCR, and Angel Oak was the first to kind of move like the biggest roadblock of actually those processes, which is one actually bank statement looking at the bank statements before you get too far in the loan. So it's part of the pre-qual thing that you guys did that in 2017. You were trailblazers in doing that, and now also you guys brought that kind of same philosophy to DSCR, right? So now actually before actually you get too far in the loan this year, you guys allowed actually that to happen where the DSCR rents are being looked at before an application is being done. It's part of the prequel, right?
Right.
Absolutely. That's
Yeah,
a huge
that's
piece
huge.
of
And
the
then
enhancements.
using that, we can avoid ordering a 1007
Right.
if the rental AVM comes out. It's amazing. Even on a refinance now, right, Ben?
Yeah,
We will use
absolutely.
what the AVM says. We're going to ignore reality and use what the AVM says. That's a deal saver, 100
Yeah.
times over.
Well,
Absolutely.
and I think actually, and listen, one of the reasons why this is a collaborative process is because it's a complicated process. Like we're making like logical decisions, not just based on, like an arbitrary guideline that's conforming to what Dodd-Frank says, but saying, okay, this person has the income, they are able to make it, whether it's through rent or actually through their bank account. We know we could do that. So you guys figured out a way to kind of make the process smoother. Um, and which is this is the big roadblock actually that stops a lot of originators from coming into this. So from what I heard, I think I'm trying to remember what the number was, but like it was like half the brokers that signed up for Angel Oak last year have never even done a non-QM loan.
Right.
Same. Yeah.
Which is
Mhm.
amazing. So that being said, so Mike, thank you for joining us. I want to get like how do you feel the show was for you, and if you could talk about like
It
the
was
energy in the room.
like Ben said, it was high energy. I noticed a lot of new people, and I actually had two brand new people didn't even have business cards yet, introduced me to, veterans that I've known for years. Haven't seen a lot of that going on lately, and now it's happening. There's young, fresh blood in the company and getting into the industry, which is nice.
So
Uh,
like what there new brokers, new originators, like what?
Brand new, yeah, like brand new to the
Wow.
business. Like I don't know, young, very young, but they're ready to go. That's great. Um,
Interesting. Wow.
that was like the biggest surprise to me. That the attendance was fantastic. So a lot of people that I haven't seen at shows in a long time, which was nice. So
Yeah. So listen, Mike. Well, why did they get into the business? Like, why now? Like, is there something going on, in
yeah,
2026 that says this is the time?
they finally woke up and there's not enough low-hanging fruit on the A side agency. And those people before who literally, I mean, Jamie and I would go visit them and they would say, we don't need, this is literally only 4 years ago. We don't need non-QM. That's like the old subprime. It's like, and Jamie would said, oh, so every self-employed borrower you have qualifies using their tax returns? That's amazing. You know, yeah, I don't even think he's in business anymore. So
Yeah.
so the need for, and if you notice, I'd say probably 90% of the exhibitors were non-QM or, pushing non-QM, even if that's not their original niche.
Yeah.
It's the only hour in your quiver right now that's worth pulling because of the inventory issue. And there's still people out there that want to be landlords.
Yeah.
Unfortunately, that's making it a little harder for first-time home buyers looking for a place to live. So that's a whole nother conversation.
Yeah. 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 I hear you. Ben, why do you think right now is a good time to get in the mortgage business?
I think I think it is again, I don't want to date myself, but I think the next generation of originators and middle management and upper management is starting to get into that younger, tech heavy, innovative sort of side. Now, don't tell Tom I said that, and Tom, if you're listening, I apologize. But I think that the technologies are coming into place. A lot of the LOs that retain their license after what was it, 23, it dropped off significantly. Those are
Yeah.
the loan officers that remain, the ones that diversified, the ones that put their nose to the grindstone. That's an advantage for them, right? I think it was something like 60,000 loan officers or something. I forgot the exact number, but didn't renew their license in 23 or was it 24. That's a big opportunity, right? A lot of your competition kind of rode off into the sunset. And I think this isn't unique to mortgage, right? I think it's always, it always kind of does that where, you get a group of loan officers, they grow old in the space, they retire. And who backfills that void is the next generation of loan officers. So I think the hunger's definitely still there. People that were out are looking to get back in. Hopefully this year, we're hoping for a normalized purchase market, even if it's not, normalized. It's everyone's predicting, the NBA is up what 7%, I think, over last year. So we have data that would support, some tailwinds. I think when you put all that together, and the evolving niche lending, right? It just any borrower walks in the door, you got to really find a solution for them. Now, I mean, not everybody can qualify for a mortgage even on non-QM, but there's many more options to fit your borrowers.
No.
It's just a huge part of it. So I think that's the reason why there's a lot of appetite, and exactly what Mike mentioned. That I had a loan officer like, hey, I just started my own brokerage. The amount of brokers leaving big shops and going to start their own, that entrepreneurial spirit, even with younger loan officers, is still that transition is still happening. So the amount of broker shops that are opening up and people going out on their own is continuing this year. So that's obviously a great opportunity for anyone in wholesale or anyone out there on our side of the street is going to going to find those relationships and partnering up with the local loan officers.
I think
Yeah.
the technology part of it has to do with it also, as far as having the the the, the guts to go out on your own. The technology piece of it is probably making it a little easier than back in the day where you had to fill out paperwork, right?
Yeah. Yep. No problem. 100%. And listen, it makes it easier to market, and it makes it easier, to kind of communicate with the lenders. The technology that you guys have. I mean, listen, and I'm going to enable this right here. So right, like simple things like the non-QM quick quote tool. Like for a lot of originators, like this is where they start their path, to non-QM. That non-QM quick quote tool, and I just put that up there. If anyone's in this webinar, you can click the resource. You should see that. Like that's the path to kind of get started. It's like little technology tools like that. I think have helped. But the other thing actually also that I think has been a huge boost is just product innovation. And if you're going to innovate and come up with a new product, like let's say you want to roll out an arm. Arms were not as common actually in non-QM. You guys rolled out a non-QM arm in 2025. Listen, if you're a big retail organization and you want to roll that out, there's a process. There's going to be a lot of training. Brokers, the wholesale channel. I mean, you do it at the end of a webinar, you're going to have actually the loan officers are on there that are going to be texting their real estate agents to talk about to set up meetings. You're going to have loan officers reaching out to borrowers saying, hey, listen, I've got a solution for you. I know you're actually looking for a 5 year. We could do this for you now. So I think actually it's the product innovation has made it sexy to be a broker again. And not that it ever wasn't sexy to be a broker, but like there was a stink in the air, because of actually, being blamed for the entire great financial crisis
Yeah.
wrongly. That the mortgage broker is not a sexy place to be, but we
Broker was a
know.
bad word. Remember, I mean,
Yeah.
after 08, it was really a bad word back then.
Loan officer.
Yeah.
Yeah. Listen, we all actually went like, and as the associations, they went from like the blah 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 Association of Mortgage Brokers to the blah 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 Association of Mortgage Professionals. Like,
Right. Yep.
like like,
Yeah.
bro, embrace it, man. Come on, man. We
Yeah.
we
The
are the
movie Too Big to Fail kind of doomed that term, that name. It made broker a bad word. It did.
That and Jamie Dimon it with his congressional testimony in 2010 blaming the mortgage brokers for this. So yeah, Mike, I'm with you on that. So I want to talk about like for what were the hot products that brokers were talking about at the show. I mean, we've dropped a couple of products here, but like what are brokers asking for right now on the street?
Oh, who are you asking, Andrew? Sorry.
I'm going to go for it. Listen, Ryan, I haven't heard from
Yeah.
you enough, so I want to know from you, Ryan. What are the brokers actually asking for? Is it DSCR? Is it bank statement? Is it asset depletion? Asset utilization? Is it some kind of combination? What were you seeing out there, Ryan?
Yeah, I think everyone right now in the market is trying to figure out, current homeowners, they're trying to figure out ways to tap into their equity. So a lot of the talk I've been hearing is about bank statement HELOCs or second liens. DSCR second lien is a program that we also offer here that's a little bit unique. But people are really trying to figure out what to do with their equity. Along with that, there's also a record amount of debt out there. People are trying to figure out what they can do with their money and work smartly to make the best for their family in the future. So the bank statement HELOCs are a big one, HELOCs in general, second liens in general. And then for New England in particular, the investment properties, the DSCR liens, especially in Massachusetts. It's a huge, huge market. And the fact that, Angel Oak as being one of the leaders in the industry now that we're in play with the DSCR program is huge. It offers investors the flexibility to, when we talk about new technology, and like Mike was saying before, and Mike and Ben, we were talking about the AVM program. So now with the DSCR program, if you have a one unit property under 75 LTV, we can go ahead and run that AVM right at the pre-qual stage, so we know what that rental income is looking like. We don't have to order a 1007, we don't have to look at an appraisal or anything like that. So, like Mike was saying, that's a deal saver. And then the ability to talk about that program at length at this show really, really boosted some of those conversations around DSCR and investment properties in New England.
Yeah, and many of those investors, they like they're the Burr investors. They've been coincidentally frozen out of their Burr strategy. Like you guys have solutions to help them unfreeze it. The DSCR HELOC. I love that. I mean, and really, there's not a lot of lenders that are offering that, and there's not a lot of brokers on the street selling it. I'm always marveled, like why I don't hear more about the DSCR HELOC out in the street. I think it's the greatest product, even just to start the conversation.
Yeah, it's a closed-end second though. Right now, Andrew, we don't have
Okay,
anything on
okay,
DSCR.
okay.
Not
Sorry about
yet.
that.
Yeah.
So
Okay,
we're teasing everybody there.
Got
okay,
excited for a minute there.
That's yeah, that
okay.
is, I mean, that as we look to evolve, then that is the next logical big program to come out. But to add on what Ryan said, a lot of conversation around short-term rental was talked about, right? I mean, you have a lot of short-term rental people. You have a lot of people that, Airbnb, VRBO, along the coast, you got your your vacation areas. And being able to navigate short-term rental,
Yeah,
you can't really do that on an annualized lease or a 1007 sort of option. So, that's sort of a unique one. Like I always get asked like, oh, well, what about short-term rental? And what we can do is
yeah,
offer the AVM before that loan even starts. So we do pre-quals on everything. So, you give us 24 hours, we're going to give you a yeah or nay, but we pull air DNA for you. And we're the most aggressive in the industry on air DNA. We don't give it a haircut. We don't give you the net profit. We give you the projected revenue divided by 12, and that's your monthly rental income. So when you're talking about short-term, markets, that's a big, big win because as we all know, and I spoke about it on stage, appraisers can't use short-term rental on a market rent 1007 anymore. Now there's a lot of other different sort of AMCs are getting clever. They're trying to put out, different types of forms and narrative forms and things like that. But right now, non-QM, I don't know anyone really accepting narratives. So, this is I think non-QM is unique in the way that we'll always sort of move with what's necessary, right? We look for those niches. We look for where's the dislocation in the market, and that's where we want to be. Because not only is there good volume and it's a relationship builder, and hey, we're helping underserved people do what they want to do. Um, but it's also it's also a lot where the volume is, and it's fun and it sets us apart. So it's always a good part, a big piece of the puzzle is, hey, your other guys can't do it, I can, and to be able to be that yes, and for our loan officers on the call, you want to be that to your borrowers and your realtors. You want to be able to say yes every time,
Yeah.
or as much as humanly possible. So that's, we want to do the same for you. We want to tell you yes, and we want you to tell your realtors and your borrowers yes. So that's what makes it all go around.
Yeah, you guys are. I think looking for excuses to say yes. Like that's it. If you don't have enough excuses, you're going to innovate products to be able to find more ways to say yes. So we just had a question that popped in from Elizabeth. As an investor with properties in Texas and Utah, I'm wondering whether Angel Oak loan officers are assigned because they're specializing in loans, short-term rental, or geographically assigned. So, is it geographically assigned? Is it product assigned? From
So yeah, so Elizabeth, we would actually want to refer you to a local broker in your area that's licensed in Texas and Utah. So it wouldn't be an Angel Oak loan officer. So we are a wholesale based company. We want to refer you to a broker partner of ours. And for the brokers on the line, that's one thing we absolutely do. We get borrower leads and things like that who come through. We want to turn around and hand that to you, right? We want you, since we're wholesale, we don't speak directly with borrowers, but we want you to have the opportunity to educate these borrowers and to expose them to these programs. Because exactly as you mentioned, Elizabeth, I have investment properties, Texas and Utah. So you never know when you talk to a borrower, hey, they may have properties elsewhere.
Yeah.
We do have 22 states that you can do DSCR loans in that you are not licensed in also. So that's a unique one, right? If you're licensed in just one state, we cannot let you operate in 22 others. So that's a unique offering that we can do as well. But yeah, but I mean, Elizabeth, that's what we would want to do in that instance. We'd want to refer you to a local broker, partner of ours, someone we have a relationship with, someone we know and trust, so that that trickles down to to you.
Fantastic. I appreciate that. So Mike, and any actually further feedback on like the hot products that brokers were talking about?
Well, actually, what you said, which is hopefully coming, is the TSCR HELOC, which that any day now probably. Um, but I've been pushing just the HELOCs in general, investor HELOC, bank statement. I mean, there's so much equity out there. Everything's locked up. Nobody's moving. Fact that they can tap that equity, and honestly, especially on owner occupied, they don't sometimes the rate is very close to where a credit union would be. If you had if you didn't have a relationship and a 740 score, your rate is going to be about the same, prime plus two. It's really not that far off. Some, owner occ, lower LTV stuff. So a lot of times people are very surprised of how much they can get. You know, you want to go to 85, go a little higher, it's a HELOC. Um, but the fact that you can do it with bank statements, people who are self-employed are convinced, if they don't already know about the bank statement program, they're convinced that they're, stuck at not paying taxes and not getting the house they know they can afford. Once again, the bank statement program opens up those doors. And if they know about it because they bought their house on it first with a bank statement program, boom, when they find out they can tap more of that equity, especially now that their house is worth 100 grand more than what it 2 years ago, it's kind of a win-win.
Yeah.
That's a huge, I mean, the equity part is gigantic. And for every loan officer that's listening to this, if you did a bank statement loan for a borrower in the last, 2 to 4 years ago, you should be in front of them talking about this program. I think average house appreciation was 18% or something, Andrew. I mean, just the spitball in there, somewhere in that ballpark, right? So your self-employed borrower has got that much more additional, equity to tap into. One of our account executives actually mentioned something, and it kind of gave me a light bulb moment. Was he actually presses, he speaks in front of a lot of small business organizations, and so and his point was, you can use the equity in your primary, your second home, or your investment property as a business line of credit. And
Wow.
that just kind of blew my mind. I was like, oh, I didn't even think about it that way.
Wow.
Exactly. It's like, oh boy. And obviously our rates are going to be a lot more attractive than a commercial loan. That there's no question in that.
Like
But
the cash advance.
that's one of those unique sort of approaches. And that's where, for all of our loan officers, getting with account executives and just kind of going through it with us, you'll pick up a lot of different ways of presenting this to your borrowers. But as I mentioned on stage, Andrew, you guys need to get comfortable with these programs, right? We understand that until you're comfortable, you're not going to talk to borrowers about it because the last thing you can afford is to not look like you know what you're talking about. So the
Yeah.
education part of this is our biggest job. I consider all of my account executives, we're not salespeople, we're educators, we're
Yeah.
educators. Like that's what we do all day. And the more we can do that, the more comfortable you are, the more we're giving you the power to go out there and originate more.
I mean, interestingly enough, I mean, this is the foundation that Angel Oak was created on. Like this, uh, like you had a Herculean task to come out with products that no one has ever heard of, that we thought we never could do again, and we'd never be able to serve a business owner. So you had to educate that A, no, this is not subprime. B, yes, we are allowed to do this. C, that it's actually safer than a lot of other loans. I mean, heck,
Mhm.
this is performing a lot better than Govy. I mean, which
Absolutely.
is not that really hard to do these days, but only separate a separate webinar that we can have. But yeah, and I think that's great. The education focus, and you guys have webinars on a monthly basis, right?
Absolutely, bi-monthly. And you're right, people thought we were nuts. People were like, what are you doing? Like, how could you be doing these loans? And obviously a big, big appreciation to our owners, Mike Fearman and Training and Hutch and all the original, guard of Angel Oak for pushing through that ceiling. It was, they were getting doors slammed in their face right after after the crash, and because they thought, man, these how could you do these loans? And we knew these were good borrowers. We knew these loans were performed. We knew, what this was. And it just took just repetition and getting in front of brokers and really hammering home why these loans were good, why they fit a specific market, and why they needed to offer these to their borrowers. And the good thing is history has proven us right. It's always nice when history proves you right instead of wrong. So for that side of things, it was, thank God for it. Because it's
Think all our early on securitizations of the bank statement programs that outperformed the agency,
mm,
Yeah,
that's the proof is in the pudding. It's in the performance.
yeah.
So kind of hard to argue with that.
Yeah, no, I agree 100%. Which, listen, the executives that were on the panel of the non-QM, like like a lot of them were at the the beginning when this all started, when you guys were out there doing those early securitizations. They weren't out in front the way you guys were, but they saw actually the early signs, early successes that you guys have had. So Ben, I'm curious. Any other feedback about the non-QM summit? Like insights that you got from some of the other executives that participated in the non-QM summit.
yeah. I mean, when speaking, obviously, I appreciated everyone for being on the panel and just having those conversations afterwards. They really like the structure of it. The fireside chat approach is always a little more, enjoyable as far as conversation goes. But the topics, I think they really enjoyed the topics being broke out the way they were, really emphasizing the DSCR programs, with the DSCR being its own sort of set, and then having programs on top of that. But then with me and PJ from Lens at the end, how to pick your partner. I think, when you have two competitors standing on stage on the exact same page, kind of talking about, hey, how you want to pick your partner, what's the important part of it. I thought, at least we all thought that was kind of, we got a lot of, a lot of, kind of, a lot of people came up to us after that and said, oh, that was really great, right? That was good information. Because, hey, there are a lot of people entering the space. That's just, because everything on non-QM is hot. So, picking your partner is a huge piece of this, right? It's communication, it's execution, it's process, it's all of those things. And when you put them together, and there are a lot of great non-QM companies out there. I'm not going to sit here and say Angel Oak is the only one. That'd be a crazy statement. Um, you know, but realizing what your partner does well, maybe what they don't do so well. The communication piece is the one thing that I think is kind of a minimum standard because that's the one thing we can always control. But I thought, as far as the content, I thought that was the big message, because it's not like years before, because I think this was my fifth time moderating the summit, I think. And the first time it was well, how do these loans work? And you get those types of questions, right? And now
Mhm.
that we're a little more normalized, and hey, we asked them to raise their hand in the beginning, and a third of the room, give or take, had done a DSCR loan, and a third of the room had done a bank statement loan. That is, still extremely low, but a lot
Yeah,
higher than it was 3 years ago.
yeah.
3 years ago, there'd be a couple hands in the air. So I think the that subprime, we don't want to do these loans are difficult, I think that has washed off
Yeah, it's
all of
gone.
non-QM, and now it's okay, I'm doing these now, but who am I going to do them with? And that was a I think that was a big part of this show.
Yeah, they're
Um,
still hungry for information, which means a lot of them
Mhm.
still haven't done it, which
Yeah.
is open
yeah.
opportunity big time.
I think that was
So,
one of my biggest takeaways from the show is the fact that LOs and brokers are eager and hungry for
Yeah.
this non-QM information. They're eager for trainings, they're eager for the knowledge, and they want to go out and use it. And for those that have maybe felt behind in the non-QM world, now they're picking it back up and they're ready to go. It's not just a niche anymore. It's a certain part of the market. So people are ready and looking for more.
You know, what was also interesting is when I got home and went through all my business cards, a lot of them were realtors and they were asking genuine questions. No MLS, MLS, but no MLS. So I found that interesting. I didn't even realize they were realtors. They were asking genuine mortgage questions. Turns out they're just realtors.
Yeah.
That
Interesting.
makes a lot of sense.
Yeah.
And so by the way, right, if everyone looks at the resource, just drop the link to the Angel Oak Mortgage Solutions website. You can sign up for the webinars on there. Like I don't need to be an approved broker to attend your webinars, right?
Nope, not at all. It's open to the public. Our quick quote, guys, we have open pricing also. So all of our programs, all of our pricing, our webinars, our past webinars are all located right on our website, angeloakms.com. It's where everything starts for us. So, feel free to go in there and play around. All right.
Just so just so you know that our quick quote is so efficient. We don't use rate sheets as AEs. We use the quick quote. And you have full access to that with no credentials whatsoever.
There's only 9 points of information. We don't ask for an address. We don't ask for
Nothing.
who you are. Unless you're going to send us a prequal, then we got to know who you are. But it's open pricing to the public. So the upside is
Keys to
you can go
yours.
and play around, and it's also sort of a scenario run also. So you
Yeah.
can say, okay, well, I need to do a 90, but I only have a 680 FICO. Can they do it? You'll see if it shows or not. It'll say eligible or ineligible. Like it'll tell you, and it'll counter. Like, okay, well, we need a 720 to go 90%. And
Yeah.
it'll so you can work on rescoring borrowers and things like that. On top of it, based on just running scenarios in the system, not even just looking at pricing.
The pricing engine can actually reverse engineer our underwriting if you work at it. You can keep lowering LTV or raising FICO to get to where you need to be, then you understand what our guideline is.
Fantastic. Um, Okay, listen, I hate to play the negative Nancy here, but any concerns? Are there any worries? Because listen, I mean, it's not like we have open seas, clear skies. Like we're in the mortgage business, and we're by the nature of what we do, we're in a volatile business where that has lots of things that are unpredictable. So, what are either executives or the originators worried about?
I
Inventory,
Yeah,
Inventory, yeah,
so
transactions
inventory is a
inventory,
problem.
yeah, yeah.
in the
Inventory is a problem
Northeast.
for everywhere. And Mike, I don't want to steer you. Go ahead, Mike. Sorry, I don't want to step on your toes there.
Mike, yeah, go ahead, continue that.
No, no, I'm just saying in the North, I don't know about the rest of the world, but in the Northeast, it just seems to be compounding a little bit. And the more investors that are out there buying single family homes for investment purposes are one less home for first time home buyers who need a place to live.
Yeah.
We're going to create a rental society if something doesn't change. And it seems like the administration's onto a couple good ideas, but the reality is we can't build our way out of this fast enough. So something's got to give.
And
HELOCs are
specifically,
the way because no one wants to touch that 4% rate they got.
yeah, 100%. Now, any other specific insights about the Northeast and about the in the New England area?
Um, it's super high end is building, I'll say that. The higher end neighborhoods seem to, well, I guess the wealthy areas never really are that affected. And luckily we have fantastic jumbo products. It's what's, keeps some of us alive in this area. Um, as far as investment properties going, we're getting down to the bottom of the barrel. Those really picked over properties. Um, but other than that, we do see also conversion of office spaces, hotels that are becoming hopefully condos, but probably rentals. So that won't really help us. But if they do become condos, that might help.
Yeah.
But I just don't see us building our way out of this quick enough.
Yeah,
The
no,
inventory
I
issue.
think the rehab is going to be a bigger part for the Northeast also. Your 203Ks and your rehab loans. Now we don't actually do that. We can take you out at the end. So we don't have a rehab type program, but a lot of investors are coming in and buying up, small mom and pop investors are going to buy that dilapidated property and really, putting sweat equity into it and looking to take their equity after it's completed and they want to go buy another one. So that's a huge, I think that's going to be part of the solution. I don't want to be Debbie Downer with the baby boomer generation, but inventory is going to tick up as, the baby boomer generation unfortunately ages out. So that's a nice way of putting it. But so that's going to have some impact. But as far as doom and gloom, of course, there's always going to be a couple naysayers out there. I think some people are a little nervous that our programs are going to go too far. Um, like where's at what point is
Not
do you
Angelo.
get away from responsible lending? I think that's where picking your partner makes the most sense because trust me, government's not coming to bail out a non-QM company, guys. It's our capital, it's our money. So, if loans stop performing, investors stop investing with that company. It's not a widespread type of thing. So, picking your partner, we don't get over our skis in some of the stuff. That, of course, there's people looking at you know, um, markets going downward, right? You have downward trends in certain areas. Obviously, there was an exodus from California to Texas. I think most of California had already swallowed all that up, so that's not really declining markets anymore. You have Florida that's a little bit, certain Florida markets are now technically declining.
Yeah,
And condos, right? Condos have been a whole thing down there since a couple fell. So you have some of those little pockets that people are definitely keeping an eye on, but so far, just the performance in these loans, and the one good thing about COVID was it was and 2022, 2023, is they were stress tests for non-QM naturally. So you had bank statement loans based on these borrowers' business who had to shut down for 6 months to a year. Unless
Yeah.
your local pizza shop, that was making a killing because everything else was closed. All of these businesses had to close, but those loans still absolutely performed. So that was a big strength, and that's why you saw a huge flood come in for non-QM right after COVID. Obviously, COVID was a little rough on a few companies. We had to pause lending because we had no idea what was going to happen. Right, no one knew if they were going to have toilet paper at the end of the day, so we didn't know what was going to happen.
very.
But that came back rushing, and then obviously the Fed raised 500 basis points in what 2 months. So that was fun in a rising rate environment for everyone on this call. But that was a big stress test. And our loans performed incredibly well. So it sort of illustrated how good these borrowers are. Um,
Yeah.
their business can't even operate and they're still paying their bills. Our forbearance requests were nil compared. Uh,
Wow.
Now we didn't go out there and advertise them. We were like,
Yeah.
we want forbearance, but still, our forbearance requests were nil compared.
That's
So,
amazing.
you know,
So, what were the executives in the non-QM summit, and the Angel Oak executives for that matter too? Like, what are you guys excited about? Like, what in the general state of non-QM, is exciting people.
who you want?
Back to HELOCs.
Uh,
There you
yes, it's a HELOC. Now,
It's
Ben, I'm curious from you, but Ryan, I want you and Mike to add this. But since Ben, you spent a lot of time with the executives, kind of preparing them, for actually their time at the non-QM summit, and probably spend more time preparing for it than anyone else on the panel there. Would love to get your insights, Ben. Them, Mike, we'll go to you. Then Ryan, we'll go to you.
Yeah, I think it's the invest on the secondary markets with the amount of investing in it that the spreads are narrowing, right? And our pricing is coming down. Right. I think that's a big, big excitement is that our rates are coming down really, really close to agencies. So
Wow.
that's important for us because we know affordability is a thing, right? We all know, golden handcuffs. We know, what 45 or 50% of the country has a rate under 4.5%. We know if we can get even closer into that, it's going to unlock a big box of borrowers. And just affordability in general, right? This is these programs are not just for your high net worth individuals, with asset qualifications or self-employed people. We do full doc. We do have a second tier full doc for first time home buyers and people out of a life event. We have a lot of solutions on that side of it too. We don't talk about it a lot, but we probably should. So, I think the affordability piece and rates really coming down tighter is an exciting part because nobody wants to do a non-QM loan at 9%. Nobody wants to do that. And you get it, right? I
On
wouldn't
the
want to do
rate.
that either. So,
Yeah.
but when your non-QM rates are now at 6.25, 6.5,
Yeah.
all right. Now, your loan officers, you got, well, your loan officer, not all of your loan officers, that conversation is significantly different with your borrower.
Yeah.
But
So, Mike, if you can share what you're seeing the excitement on, in non-QM, from executives, or it could be actually, just the other actually reps that you talk to.
I think the expansion of the programs, like Ben said, is just going to keep happening. But you know, you can count on Angel Oak not being the first to make a crazy change.
Yeah.
We're safe. We're not that crazy lender that's going to come out with some new shiny object.
Yeah.
Um, we do what
One
we
month
do.
bank statement, borrower stated P&L.
exactly. Yeah.
Yeah, we'll never be the first. We'll be the first on something that's smart, like the no 1007 rental. That was,
Yeah.
I mean, that's a game changer.
Yeah. Or the arm,
First, I'm sure others are going to do it now as well. And that seems to be, I've been here almost 8 years. That seems to be the what's exciting about kind of working here is it's like follow the leader because, we hold on to our loans, we maintain domestic servicing rights. We know what's going on with the loans. And I think like when we change rates or do something drastic, I think the other lenders just follow what we do, to be honest. It's kind of like a
yeah,
follow the leader sort of
yeah,
thing.
yeah, 100%. Yeah. Ryan, what about you? Any other insights? What are executives, account executives, excited about when it comes to non-QM?
Yeah, I think for a lot of touching on what Mike said earlier, I think a lot of my conversations are with young, fresh LOs, account executives who are new to the business and they're hungry for opportunities where some of the older folks in the industry might not have touched, or they're a little afraid of, going into non-QM, or they don't want to, they just want to stick to their bread and butter. But a lot of these fresh young faces, they're really, really eager to learn. So that gives me some excitement about the future of non-QM growth. And then when it comes to executives in New England in general, outside of Mike's territory in Connecticut, we haven't had too many people Angel Oak wise or too much coverage in New England. So I'm really excited to get out there, boots on the ground, introduce myself to those I haven't introduced myself yet, and really, really get this DSCR program boosted in Massachusetts. It's a huge market. So just excited to get out there and continuing to teach people about Angel Oak and non-QM in general.
Another point about the new LOs is if you take the time to teach them and, go out of your way to help them
Mhm.
and even let them know, if you have a question about basic mortgage stuff that you don't want your boss to know, you don't know, call me, whatever it is, even if it's not non-QM. I have a relationship. I have friends people I still talk to once in a while from 15 years. They're not even in the mortgage business anymore,
Oh,
but we're
wow.
still in touch because I spent the time, when their boss was too busy.
Yeah.
So it's worth it.
It's awesome. Fantastic. All right. Anything we left uncovered that we should have covered?
Hmm. I can't think of
Great.
anything, honestly,
All
Andrew.
right. I think we hit it all. Like I know we had a quick call yesterday saying, hey, we want to make sure we cover these things, cover the conversations. But Listen, just thank you guys. I appreciate it. I know actually that there are a lot more borrowers in homes thanks to the work that you guys do, and your focus on educating the industry. Whether they come to Angel Oak or they go to the second or third best or the fourth best non QM lender. It's just good to know actually that you guys are doing whatever you can to kind of just bring more awareness to non QM for the originators. So thank you guys very much for the support. Appreciate it. And thank you for joining us for another NMP webinar. We've got we do these on a pretty regular basis. We got a non QM town hall coming up later on this year. You're going to want to join us for this. Thank you, everyone. You all have a great Wednesday, and hope your January is starting off strong. Take care, everyone.
Thanks, Andrew.
Thank you.